Well, joining me now from New Jersey is Thomas Russo. He was the vice chairman and general counsel at Lehman Brothers. In Ann Arbor, Michigan, we have Michael Barr. He was the assistant secretary for financial institutions under the Obama administration. And in Baltimore, we have Laurence, who's the author of The Fed and Lehman Brothers Setting the Record Straight. Gentlemen, good to have you on The Newsmakers. Michael Barr, let me begin with you. 10 years ago, was it the correct decision to allow Lehman to die?
I think it's very hard to judge after the fact the particular decisions that policymakers made at the time. I was not in the government in the fall of 2008 when Lehman failed. My understanding from what the policymakers said at the time was they did not believe that there was anything the Fed could do that would be effective given the huge capital hole and the bleeding of clients away from Lehman Brothers at that moment. And, more broadly, I think the basic problem was the government was put in a horrific position that fall where even the basic choices were too constrained. There was basic choice of putting Lehman into bankruptcy or potentially providing indefinite lending from the Fed, and I think neither of those would have been especially attractive. And that's one of the reasons for the need for deep financial reform in the wake of the crisis to try and avoid that in the future.
Yeah, Thomas Russo, did you feel aggrieved that others were bailed out, but you guys were allowed to fail?
Yeah, I thought it was a bit arbitrary. They saved Bear Stearns, and then they saved Freddie and Fannie before Lehman, and then I think there was some expectation that the central bank would be there. And then, of course, 2 days later, they saved AIG, and then that following weekend, they made bank holding companies out of Morgan Stanley and Goldman Sachs. And they basically turned the spigots on for all banks and investment banks, and they let Lehman go. And their excuse, or I should say, their reason was that there was a lack of sufficient collateral. And I think over time, when this has been actually looked at, there was more than sufficient collateral, and there isn't one shred of evidence, as far as I know, that they actually made the decision based upon a lack of power. I think they made the decision as a political decision, because of the mood in the country.
Okay, so Laurence, was it arbitrary? So you have this massive earthquake, nobody expects it financially. Was it just a sort of coin toss? We'll save this one and let that one collapse?
Well, I essentially agree with Mr. Russo's point of view that it was arbitrary, or there was no reason to let Lehman go while saving the others. As Professor Barr said, the policymakers at the time have insisted that there was nothing in their power that they could do legally to rescue Lehman, but that is simply not true. The policymakers had never actually backed that up with any evidence. And if one looks at Lehman's finances, as Mr. Russo said, Lehman had plenty of collateral to borrow the money it needed to keep an operation for some time, maybe to survive in the long run, maybe to have been wound down, but certainly some resolution of the problem could have been found that was less disastrous for the financial system than just telling Lehman you have 6 hours to file a bankruptcy petition for the largest bankruptcy in history.
Michael Barr, so looking at where we are now in 2018, what happened in 2008, at the heart of it, you had, I guess, greedy banks lending money to people they knew would not be able to pay back those loans. Those loans are a little bit murky. They get repackaged into weird things that very few people understand, credit default swaps and so on and so forth, and you have these ripple effects. That's happening today in 2018. Does the fact that that's still happening in 2018 mean that nobody's learned the lessons of 2008 and that this might happen again?
Well, I think there's always a significant risk that you put in place the kinds of conditions that will lead to the next financial crisis. I think that the financial sector is much stronger today than it was 10 years ago because of the reforms that were put in place in the wake of the crisis in the Dodd-Frank Act in the United States and globally through the Financial Stability Board and in other countries. So there's more capital in the system now. There's more oversight of derivatives markets than there was before. There's an ability to wind down large firms like Lehman Brothers or AIG through the orderly liquidation authority if they get into trouble. So there are a set of reforms that are making the system safer than they were before. But we're already at risk of forgetting all of that. Right. I think if you look at what's going on in the United States, there's a significant sense that we're going to see deregulation under this administration, a rolling back of the reforms, and I think that is extremely dangerous.
Yeah. Professor Barr, tell me a little bit about trust. When, for example, back then, Ben Bernanke said, well, subprime won't be too much of a problem, right? So when somebody watching this program hears you going, well, we're in stronger shape right now, is it harder for you to actually get people to trust your analysis that the system is pretty strong, given that in the past, people just couldn't see this thing coming?
Well, I think that people should be appropriately skeptical about the strength of the financial system. And I think one of the risks that I see is that people are becoming too complacent, not too willing to reduce the capital standards that were put in place, too willing to relax reforms in the consumer market. So I think it's healthy for the public to be skeptical of the strength of the financial system and to insist on continued reforms to make the system safer.
Right. Thomas Russo, I've got some figures about the Lehman Brothers CEO, Richard Fuld. Between 2000 and 2007, in terms of a combination of shares sold and bonuses, he made $522 million. This is according to a Harvard study. So when we look at that, even though you feel, okay, you guys shouldn't have been allowed to crash and others were saved, at the heart of it all, you have taxpayers within the United States and ordinary citizens around the world who feel that greedy bankers made all this money, screwed things up, still got a healthy paycheck, and they had to suffer and they had to fit the bill. 10 years on, do you accept that that was perhaps the reality?
No, I don't, because the figures that you gave are terribly misleading. And I'll just give you an example. The way I'll take the Lehman case and you could take Dick, or you could take, frankly, my own compensation. The vast majority of compensation was in stock, vast majority, maybe 80% in some cases. And that stock didn't become yours at Lehman until 5 years after you've earned it. So essentially you're working, you got to wait 5 years. So at the time of the bankruptcy, the vast majority of your compensation was worth zero. So that the numbers that you take from the comp tables, those are the numbers based upon when you earn them. But what you actually get and pay taxes on is what you get at Lehman, at least 5 years, which is much longer than most. So that if it was that people were incentivized to do anything because of the compensation, I thought it was quite the opposite, because you had the vast majority of what you made over 5 years that ultimately was worth zero at Lehman. Now, of course, all the other companies that were saved, you had slightly different story. But even at AIG, the vast majority of the stock went down. I don't know the percentage.
Okay. All right. So, Laurence Ball, has this been overblown? The fact that these CEOs and others and bankers get bonuses, they made millions, but ordinary people lost their jobs, lost their homes, had to pay more taxes in order to save companies. Was that overblown 10 years ago?
Well, it's certainly horrible that so many people lost their jobs and there was such a big recession. That's not overblown. It is not really true that the taxpayers paid money for the so-called bailouts. There are misconceptions about that. The Federal Reserve lent money to banks, but that money was paid back with interest. They could have lent a Lehman rescue would have involved lending money to Lehman that almost certainly would have been paid back. So there were not any direct costs to taxpayers in the sense of giving money to bankers. There were terrible costs of the fact that Lehman was allowed to fail, and there was a big recession, and millions of people around the world lost their jobs.
Michael Barr, if you'll allow me to wade into political territory, there are those who make connections between the populism that we've seen over the past few years, whether it's with regards the election of Donald Trump into office, Brexit, populist movements, and a new kind of spiky nationalism in Europe. They make that connection between the global financial crash in 2008 and all of this that came afterwards. And of course, they are historical parallels. They say Great Depression, fascism comes afterwards. Is that accurate?
Well, I think that there are a broad range of factors that have led to the rise of populism in the United States and around the world in the last really 30 years. If you look at basic problems in the stagnation of wages for middle-income families, if you look at the rise of anti-immigrant sentiment and xenophobia around the world, these factors are important. I do think that the financial crisis and the economic devastation that it caused was a further accelerant to what was already a rather troubling trend. So I think it played a role, but it was not the only thing driving what is a significant increase in nationalism, xenophobia, anti-immigrant feelings, and a move towards authoritarianism that I think is quite disturbing globally.
Okay, so all of those moves towards nationalism, xenophobia, and so on, Laurence Ball, have they been ripples of the cataclysmic events of 2008? People look at a country like Greece, for example. Was that a ripple of the financial crisis?
Well, as Professor Barr says, there are lots of political factors. I certainly think that the economic problems in Europe were affected very, very strongly by the financial crisis in the U.S. The financial crisis in the U.S. and recession in the U.S. led to recessions in Europe, and that greatly exacerbated the debt problems in Greece and elsewhere. So certainly the U.S. financial crisis spilled over into a lot of economic hardship and suffering in Europe. I am not a political expert, but common sense suggests that if people are losing their jobs and in great economic distress, they will be angry, and that if millions and millions of people are angry, that will be a significant boost to essentially misplaced anger will be expressed in places like Brexit and the U.S. presidential election and other sorts of populism.
And Thomas Russo, for those who look at what's happening right now around the world, and they see that subprime mortgages are back, when they see an emerging market currency crisis in places like Argentina, places like here in Turkey, when they see some of the echoes of 2008 and they see some similarities and they're worried that there's going to be another big crash, do you concur with them that we're on the verge of something big?
Well, I don't know if I'd say it's the verge of something big. I think one of the issues that I see is that if we talk about things in terms of 2008, we may be stuck with solutions of problems that occurred in 2008. And I'm not convinced that that's going to be the main source of any problems. I mean, if the emphasis is the banks should have more regulation, et cetera, that's not looking at life holistically. You have to look at the consumer, you have to look at rating agencies, but you also have to look at more what I would call financial infrastructure issues, such as Social Security, Medicare, pensions, and if the main cause of the problem in 2008 was leverage by everybody, by the consumer, by everybody. If that was it, and you look at it today, you could make a very strong argument that the leverage that is there with the unfunded liabilities, particularly in the pension system and the Medicare system, that could be a cause. And unlike what happened in 2008, where you had the Fed doing what it did and a lot of fiscal stimulus, at some point with the deficits the way they are, you could have a problem at the federal and state level, and there is no governmental body above that to do anything. So that, to me, is a much more holistic way of looking at the problems, and we don't seem to be able to solve those because that takes a political determination. And politicians live very much in the short run and getting elected.
Right, Michael Barr, as you mentioned, Michael Barr, earlier on, the political determination from the Trump administration seems to be less regulation. So where's that balance right now? Where's the balance of power? Is it with the free markets, which might lead to more trouble because with less regulation means less oversight, means people can get away with more?
Yes, I'm quite worried about that. I mean, I think that there's a kind of collective amnesia that has descended on Washington about the causes and consequences of the financial crisis that were so devastating to American households and businesses. And there does seem to be this move to try and roll back the reforms that were essential to making the system safer. And as I said before, we not only need to keep those in place, but we need to further strengthen the system and look out for new risks where they arise inside and outside the banking system, in derivatives markets, in high-frequency trading, in money market funds where the reforms were not fully put into place, in rating agencies and securitization. So there's risk that is throughout the financial system. And if we're not on top of them, if we get complacent about risks in the system, we're going to recreate the conditions that led to the last financial crisis.
Okay, Laurence Ball, tasty headline that came out very recently, a couple days ago. Experts at investment bank JP Morgan saying the next global financial crisis will begin in 2020. Doomsday scaremongering or something we should take seriously?
My goodness, if they actually know what year the next crisis is going to be in, they have a crystal ball. I can't imagine how they come up with 2020. I think the history of finance teaches us that there are periodically crises. I mean, the nature of financial markets and capitalism is that risks are taken, and sometimes regulations are effective, sometimes they're not, but accidents will happen. And as Professor Barr pointed out, the risk of accidents is going up, probably because of regulations, because of the deregulatory environment politically now. But I think it's very hard to say when there's going to be a crisis. I mean, a few years before the last crisis, subprime mortgages were a new thing. Nobody dreamed that they would be something that would bring down the whole world economy. So we don't know when the next crisis will be, but it will happen one of these days, and it will probably be for some reason that nobody anticipated beforehand.
Yeah, a strong case for humility, especially since what happened 10 years ago just blindsided everybody. I can't believe it's been 10 years, but gentlemen, it's been fascinating picking your brains. We covered a lot of ground. Thomas Russo, Michael Barr, and Laurence Ball. I thank you all for joining us here on The Newsmakers.